Welcome to the first week ahead for 2025. And whilst we have seen the year already kick off, this coming week really marks the beginning of the year for financial markets with the release of inflation data coming out of the eurozone and jobs data out of Canada and the US. We're expecting to see plenty of fireworks in the week ahead. So let's jump into the data. This is an overview for the big ticket items according to Trading Economics. And like I said, inflation really dominates the beginning of the week within the Eurozone. We've got the numbers coming out of Germany on Monday, leading us into Tuesday's Eurozone figure. And as we can see here, there's an expectation that we see that Eurozone number moving towards the upside. 2.4 expected on the headline inflation rate. But as we do with these videos, I'm going to show you exactly why we shouldn't necessarily expect to see any sort of major concerning signs coming from the inflation data from the Eurozone and the implications when it comes to the euro going forward. Beyond that, ISM services PMI, that's going to be really interesting out of the US. We've got FOMC minutes on Wednesday, the trade data out of Australia and Germany on Thursday, and then on Friday, jobs data out of both Canada and of the US. And we're going to start off with that US focus. We can see here Monday, factory orders, ISM PMI on Tuesday alongside JOLTS job openings. And that kicks off a period where we see data on the jobs market on a daily basis. So Tuesday, the JOLTS job openings, Wednesday, the ADP payrolls, Thursday, the initial jobless claims, and Friday, the main jobs report coming out. Now, key to this, of course, is this idea at the moment that is essentially bad news or bad data should be good for markets, because it's this sort of pulling back in terms of expectations around the Federal Reserve that has really sent some jitter throughout equity markets of late. And certainly there's this perception that with Donald Trump coming in and the expectation that he's going to have this sort of pro-growth strategy, but also a potential inflationary policy mix, that provides the basis for the Federal Reserve to potentially sit back and say, we don't necessarily need to do much. The economy is going to be looked after by Donald Trump, but also inflation might rear up. So if we were to also step in and enact a raft of rate cuts, that could really build on what Donald Trump's doing. Then we could potentially see a surge in terms of inflation pressures. And that's the last thing that we really need. So that's a large part behind why people are thinking we're going to see so few rate cuts over the course of the year ahead, which is a significant shift from where we were not so long ago. And so really what we're going to be looking out for here is, do we see signs of weakness that might push the Fed towards feeling like they need to do more, right? And so the payrolls number from last time around, we saw 227K on the headline number, and we also saw an upwards revision to the previous number. This time around, they're expecting the figure closer to 200K. That still remains relatively strong, but I think key to this is that unemployment rate number. We saw it rise last time around. There's an expectation we rise again to 4.3%. The average hourly earnings already are relatively elevated at 4%, but there is an expectation that that drops down to 0.3 on a monthly basis. That's still tracking above that 0.2 figure that we need to see sort of there or below to be able to get back down to sort of earnings that are in line with inflation. But, you know, I would say average hourly earnings of sort of 3%, you know, that's probably a sweet spot. It's good for people's real income to be able to rise as well. We don't necessarily want it to provide the sort of underlying inflation pressure that's going to drive CPI and the core PCE metric upwards. The FOMC minutes alongside Friday's jobs report should provide the basis for markets to get a greater idea of exactly how many rate cuts we're going to be seeing, because bear in mind the Fed event itself, the latest Fed meeting, saw a dot plot that provided an outlook for 2 rate cuts in the year ahead. Well, markets went ahead and essentially said we're only going to see 1. That has been shifting a little bit, and we're now in a point where markets just really undecided whether it's going to be 2 or 1. This is the current state of play for the jobs market, a sort of overview. You can see unemployment has been ticking up, but it has been, you know, we've kept the lid on it to a large part. But if we do see it moving towards the upside, then, you know, we could start to see a little bit of fear creeping in. Like we said, on the payrolls, 227, but the trend still does remain towards the downside. So the expectation of a 200K mark would sort of play into that theme. Average hourly earnings 3.91, essentially at around 4%. And so, if we see downside for average hourly earnings, that could really help things because it eases inflation expectations, and participation rate sort of struggling to really make much traction from here. Like I said, in terms of expectations within the markets, it's now pretty much a split between 2 rate cuts or 1 rate cut. And you also see an outside chance that we see 0 rate cuts, around about a 10% chance. And that's a similar kind of chance attributed to 3 rate cuts. So markets are really undecided at the moment. But there's a perception it's going to be 1 or 2 rate cuts. So the shifts in terms of those expectations are going to come from stronger or weaker economic data, be it the economic data within the economy as a whole in terms of GDP, or is it in terms of PMIs or jobs data, or inflation, which of course is going to be absolutely key in terms of expectations going forward. But certainly the shift in terms of those expectations potentially towards 2 rate cuts could come if we see weak data coming in, if we see higher unemployment, if we see a lower average hourly earnings, if we see weaker than expected payrolls number, then we could start to see expectations of a greater number of cuts rather than the one that up until recently we have been seeing markets pricing in. Now, key to this is that markets aren't necessarily in a great place at the moment in terms of the whole Santa rally thing. And, we saw a pop, but it didn't necessarily last very long. Sort of Santa came before Christmas, but he seemed to leave pretty swiftly afterwards. And we ended the year with a pullback back towards this 76.4 Fibonacci level, which we can see down here at 5.7. I'll have to look at it myself. It's around about 5.790. So from a wider perspective, of course, this is the kind of market you want to be in, right? So you see periods of downside when you're seeing sort of major sort of collapses within the economy, be it financial crises or be it COVID pandemics. But ultimately, the trend remains very bullish, and pullbacks are generally fleeting in nature. So for something like this, there's different ways to look at it. I mean, ultimately, you can look at it from a sort of trend line perspective. This is the extreme kind of move that you would come into on a really sort of wider pullback. Within that, you're going to see sort of smaller pullbacks. You also see very small pullbacks within this. This is somewhere in the middle of that. Now, let's just get in terms of a indicator. One good thing within a highly trending market is a moving average ribbon. This isn't necessarily something I've prepared here, but it's something that, looking at this chart, is the kind of thing that I think would be particularly useful. So it gives you some of the main moving averages that are utilized, the likes of the 20, 50, 100, 200, right? And what we can see here is that we're closing in on this 100 SMA. And what's notable for me when it comes to utilizing indicators is, has it worked in the past, right? And so we can see here with the 100, we tagged it, and this was the absolute bottom. We tagged it three occasions here back in September. We did the same thing. We bottomed out here in April. We can see back here, this was a sort of cluster around some moving averages. But certainly we're in a point of time where you can see that some of these sort of deeper moves that don't necessarily come into the extremes of this trend line, but come beyond that, the realms of those sort of short-term moves, they generally sort of end around this 100-day SMA. And that's pretty much where we are at the moment. Now we've come back into it. We've got the prior low here. We've got the 76.4 fib. So I think this confluence of Fibonacci, the prior historical low, and the 100 SMA provides the basis for a potential bottom here. So I think there's a good chance we base out here. Certainly if we were to see some weak data coming out of the US, that could start to build confidence that we see 2 rather than 1 rate cut. But certainly, we're looking at a highly trending market. Okay, there's some fears about inflation, but, I would say they're unfounded at the moment because Donald Trump's not come in. He hasn't actually announced his new policies. And I think that if you look at the kind of inflation that could come around, it's likely to be goods-based rather than services-based because of the tariffs. and goods inflation isn't necessarily a problem at the moment. As long as services inflation is moving towards the downside, then, you know, a little bit of goods inflation, I don't think is a massive problem. And certainly if you look historically, when Trump came in before and started enacting tariffs, we didn't see a massive surge in terms of inflation. So you can see here, this could easily be a bottom. And if we look at, say, the shorter term perspective, how's this playing out? Well, we saw this sort of collapse, the big rebound, fell short of that prior high, and then we've been selling off it since then. But we've been seeing some chop, right? Because if you see, maybe the hourly will show it a little bit better here. So we're seeing this lower high, lower high, lower high, but then we saw this higher high selling into a lower high. So we're seeing some indecision at the moment. This could start to look like a bottom, but then we sold off into a new low. So there's certainly some question marks being asked. There's still risk of another decline back down into that 76.4 fib support level. So look out for whether these fib levels get respected. But certainly, I think whether we sell off and base around this level or whether we break up through 59.40, I think there's a good chance that the bulls are going to be coming back into play soon enough. And certainly if we see weak data coming out of this jobs report and coming out over the course of the week, that's going to be really important. One other heads up is if you're looking at the data, don't overlook the ISM services PMI. Like I said, the inflation in the US is services led. And the ISM one is particularly important because it gives us gauges for prices paid. So the underlying inflation PMI number. So if you look at, say, trading economics and you type in ISM services prices, it will come up with a chart for exactly what that reading is at the moment. Now, I'll do it myself. I haven't got it up on screen at the moment. ISM services prices currently in at 58.2. Of course, that's massively above that 50 metric, but it's been flatlining. It's down from the 59.4 that we saw in September. If we saw weakness in that prices element, that's another kind of thing that could be bullish for markets because it points towards an easing off in terms of that growth rate of inflation within the services sector, which has been a significant problem over the course of the past year. Next up, we're looking at the eurozone. Inflation coming out on Monday from Germany. That is likely to be about 1 o'clock. But prior to that, we have a raft of regional data points as well. So it's worthwhile looking out for that. Don't get me to say any of these region names because I don't think I'll be able to. Nonetheless, Tuesday, French data coming out in terms of inflation. And then ultimately, we're looking for that eurozone figure, 2.2 up to 2.4 expected. And then 2.7 expected to remain for the core metric. So you could say, well, headlines rising, core is above target. You know, maybe we need to start thinking of the euro in a more positive light because the weakness in terms of inflation figures is starting to reverse. I wouldn't necessarily say that that's the case. If you can see here, the month-on-month metric for the headline number is expected to come in at 0.2. That's up from the minus 0.3, but ultimately it's still at the kind of level that is not a problem, I would say. And then if you're looking at the core inflation, you're going to be looking here at, here we go. So the expectation for the core number, let's see if I can find it here. Not available on trading economics. Is it available here on the Forex Factory? Let's see. No. So we're not getting a month-on-month figure for either of those. But let me show you exactly why it's not a problem that we're seeing a rise in terms of near-term core inflation in particular. And that is highlighted here. And so this is the breakdown that I always provide for you guys when it comes to inflation. This one is core. So as you can see, 2.72 on that core figure. Last time around, minus 5.7, or is it minus 0.57 on the November reading, right? So if we move up to 0.2, that's not a problem. The key thing here is, right, so if we're at 2.72 on core inflation, and that's higher than the headline number, when are we going to see that decline? Well, January, when the January figure comes into play and that's stripped out, we're likely to see it rise. But then February, March, April, we've been talking about this for months, right? When that actually shifts and we see those figures dropped out, you can see all the figures from July onwards, July, August, September, October, November, all of them very low numbers. So when you replace the figures over the course of the next like 5-6 months, then you're looking at a CPI figure that is absolutely tiny. And you can see that at the bottom, right? The annualized 6-month figure, 0.52. So that means if the last 6 months are replicated again, the core inflation figure is going to come in at 0.5, essentially. So that's well below the 2% mark. And it points towards a ECB that's going to have to potentially ramp up easing, but certainly not take their foot off the gas when it comes to easing, because they can focus on trying to grow the economy. But that comes to the detriment of the euro. Now, we can see that here in terms of the differential between euro yields and US yields, and how that's influenced the likes of euro dollar. Are we seeing a shift in terms of that? Like, are we expecting to see US inflation suddenly collapse, or eurozone inflation suddenly spike? And that shifts expectations in terms of monetary policy? Well, not really. And so actually, I think this is the 2-year comparison. And so I would expect to see further downside when it comes to the yield comparative, and further downside when it comes to euro dollar as a result. And in particular, if we see weak inflation data, which, like I said, over the course of the next 5-6 months, I'm expecting eurozone inflation to pretty much collapse when it comes to the year-on-year figure as those figures drop out, apart from when that January number drops out, then I'm expecting to see more of the same, really. So this is the monthly time frame, just to give you a long-term perspective. This is something that has been playing out for a long time. Let's just get a trend line on here just to show you the sort of the direction of travel. And, we were talking about it when it was up here and talking about the likeliness of this rolling over. Well, month after month after month, we're seeing that. And we've now dropped down through support, which is down here at 1044. So call it what you want. It's a double top formation. But essentially, support's now been broken in the direction of the prevailing trend, following a 61.8 Fibonacci retracement and then a consolidation into trendline resistance. Now we're heading lower. The daily time frame looks something like this, and so you can see very clear bearish trend in play at the moment, but we're seeing a bit of a pop here on Friday. So that's not necessarily a bad thing. I mean, counter trend moves are what you're looking for a lot of the time when you're a sort of trend following trader. And so you can utilize Fibonacci's and say, okay, if we come into a deep fib zone, then we could look for potential shorts, or you could look for a sort of medium time size retracement and a breakthrough support, or there's a number of different ways that people can utilize this and potentially play it. All I'm saying is that in my mind, I think that there's a good chance that this short-term rally is short-term in nature. The trend is very clearly defined. If we break up through this swing high that we have here at 10458, then things might look a bit differently. But whether we come into a short-term retracement, whether we come into the wider retracement, it remains to be seen. I just think that the outcome from what we're seeing at the moment in terms of this rebound is likely to be another breakdown through that prior support level that you can see, which is at 1022. And certainly the inflation data coming out of the eurozone is going to be key to this. Now, also key to this is expectations for the US. And like we've gone through, we've got the US jobs report. So keep a keen eye out for that. If we see particularly weak data over there, then we could see a bit of shift in terms of expectations towards 2 rate cuts rather than 1 from the Fed, which could provide a bit of weakness for the US dollar. But I don't necessarily think it's going to see massive weakness on that front. And, arguably such a move could provide us with the basis for further near-term retracement. But ultimately, like I said, in 6 months' time, we could see 0.5% on Eurozone core inflation. So those rate cuts are going to continue to come thick and fast from the ECB if they want to do something about that, and they want to try and rescue the state of affairs for a Eurozone economy that has been floundering, to say the least. And finally, let's look at Canada. Now, Canada, we have a raft of data, but ultimately it's headed up by Friday's jobs report. We've also got those PMI numbers on Monday. But as we can see here, 6.8 on the unemployment rate, an expectation of a drop-off in terms of employment change, a participation rate expected to decline a little bit. The hourly wages expected to remain flat. Now, a couple of charts worth looking at. First and foremost, unemployment, certainly a bigger issue in Canada compared to many of its developed peers. Like I said, 6.8%. That's over and above all of the countries that I've got on this chart. And it's a relatively rapid ascent that we're seeing as well, akin to the move that we're seeing for New Zealand, I would say. They look pretty similar in terms of their pathway. It's only that New Zealand's more like 5 and Canada's more like 7. So unemployment is a problem that they would like to address, and that's why we have been seeing a raft of rate cuts thus far from the BOC. But nonetheless, we also need to consider the earnings. So wage growth, US hourly earnings, New Zealand hourly, Canadian weekly, and UK weekly. There's just different ways that people look into this. Generally, so what we can see here is that the UK figure is the one that's over and above at the moment. We did see a spike last time around, but you might say that doesn't look like the last figure that we saw for the UK weekly earnings. And that's because UK provides a metric that is the last 3 months into an annual figure rather than a single month. This is the single month. So, you know, you're looking at a different way of gauging it. And ultimately, the metric that people generally utilize, the sort of 3 month rolled into a year, that would be below the figure that we're seeing for the Canadian number. Nonetheless, I wanted to try and standardize them across these. But what's notable here is that the UK figure looks like it was on a downward trend for some time. You can look at that purple line throughout 2023 into 2024. It was largely on a downtrend, just not necessarily sort of getting as low as they would have hoped. And then we've recently seen a bit of a pop, and that might be, you know, a one-off, and that's why they roll up the sort of 3 month thing. They try and get rid of short-term volatility out of the figure. Well, that is a different story from what we're seeing for Canadian wages, and you can see that figure gradually stabilizing and then moving towards the upside. So it's moving in the wrong direction. Notably, you can see that it's moving in the opposite direction from the likes of the New Zealand figure, which you can see in the light blue line. Now, both of them, both the BOC and the RBNZ, have been cutting rates. So I thought that would be an interesting pair to be sort of playing off against each other and looking into. And we can see exactly that here, why it's a particularly interesting chart at the moment. So this is the weekly time frame. You can see in terms of a trend, the long-term trend is bearish. You can see we seem to have sort of topped out here with the fact that this sort of rising channel has now been broken. So it does provide the basis for a potential decline from here on in line with that wider downtrend that you can see, that multi-year downtrend. So we have got the wider sort of explanation for why we could see weakness here. And that's exactly what has been playing out of late. You can see that decline falling through. We're trying to rebound a little bit. But like I said, we've got justification for this decline to continue and extend lower. So the gains we're seeing at the moment, I think any pop here is likely to be short-lived. I think there's a good chance that we stay below this near-term swing high, which is at 81538. So that would likely be a retracement and that bearish trend play out once again. Key to that is going to be the wages number, which if we see further strength in terms of Canadian wages, it once again highlights that differential between the two economies. Also, you've got the sort of energy in play at the moment with the sort of rebound that we're seeing in terms of crude prices. So if I was to put, say, WTI on this, I don't necessarily know that this is going to tally up, but worth looking into. So if we put WTI, and of course, because we've got New Zealand CAD, we want to see, because it should be beneficial for the Canadian dollar, we want to inverse it. So it's on this side. Let's invert the scale. There we go. Lo and behold, it works really well. So the strength of the of WTI or energy markets does provide the basis for strength for the Canadian dollar as well. So look out for energy markets. Look out for the wages figure from Canada, both of which should provide really interesting backdrop for the likes of the New Zealand dollar against the Canadian dollar, which has, from a long-term perspective, been trending lower. This is the monthly time frame, now broken out from that channel, and likely, in my mind, to see a further downside to come for this pair. I hope that's been useful for you guys. Another 25-minute video, but you know, as long as I'm providing value, that's what it's all about. Plenty to sink our teeth into as we kickstart a new year. That's going to be a massive one. Donald Trump's not even come into power yet, so believe me, we're going to be seeing plenty of fireworks in the year ahead as we see him try and wrangle trade relations with different countries around the world, and the potential rebound for China. And there's a huge amount going on in the year ahead, but certainly just for the coming week, there's going to be plenty to get into as we sort of restart our sort of trading activity following a nice break over Christmas and New Year's. I hope everyone had a good festive period and is fully geared up for the new year. Thanks a lot, guys.